Welcome to this edition of Stock Market Pulse. My name is Eric, and we are on February 8th doing the video after hours tonight. And if you haven't done so already, be sure to subscribe to my YouTube channel for more videos and trading ideas, trading strategies. I do want to mention that I did release my 2016 trading plan a few weeks ago. If you haven't done so already, you should also go over there and check it out. It's just stockoptionassassin.com. You can see it on the home page. And a couple of the things we're going to be talking tonight are actually in that trading plan. So the first thing we're going to go over is sort of the current macro environment. And I like to look at a handful of ETFs to get an idea of what's going on. So let's take a look at those. So one of the first things I like to look at is obviously the S&P 500. I'm going to take a look at the SPY, and I want to just talk about sort of the formations and things that it's looking like. So I do have a daily chart on here, and I have I want to sort of point out the August low of last year, and I kind of want to just talk about that sell-off. And then we had the subsequent bounce. We chopped around a little bit. Things look like we're going to get kind of ugly again, and then we rallied off to not quite make new highs, but we did rally back up and sort of retest the highs, if you will. So with the current sort of sell-off we've had in January, we have a similar situation where we've kind of sold off. We got a nice little bottoming tail around 180 or so. We've kind of rallied back up, and we're sort of retesting that area now. So this is really kind of a critical point for the market. If it doesn't hold these levels, it could go much lower, probably into the SPY 175. We're probably looking at 1750-ish on the SPX. But I do want to sort of point out that we are very oversold. And if you weren't short coming into today, today is not the day to get short. So I wanted to sort of put that kind of out there because I get a lot of people, oh, should I buy puts? And if you're buying puts when the market's down 1.35% with a big bottoming tail, I think the odds are in your favor to wake up to a headache. So I actually picked up some calls at the close today, some SPY calls. And what I was looking at is a 4-hour chart. And I use a lot the DMI stochastic extreme, and you can see it was very oversold heading into Monday. We kind of came back up, very small position. What I'm really looking for is for us to fill this gap. And just from a macro perspective, and I talk about this in the trading plan, is you kind of want to know when Fed announcements and earnings and all that stuff is. And we do have some testimony coming out of Yellen, I think, this week. I think it's Wednesday, Thursday. You might want to double check the times on that. But I'm thinking that the market possibly bounces into that, and then it's sort of anybody's guess according to what the Fed says. If they sound too hawkish, we're on track to raise rates for March, then I think the market probably reacts to the downside. If they take March off the table, that could be a different story where the dollar could actually head lower, and stocks could probably might be able to bounce a little bit, knowing that the Fed isn't going to completely pull the punch bowl away, although they're kind of doing that. But I do want to be careful on the short side over the next couple of days, right? So we could very easily sort of wake up short, but I would expect these levels to hold into the Fed announcements, barring any other European type news or whatever. So I'm looking at this bottoming tail and thinking that this lower band on the Keltner channel, these previous levels, hold a little bit, or maybe we retest yesterday's low. I am looking for a little bit of a gap fill. So if I have some call options, or with my call options tomorrow, if we do bounce into that, then obviously I'm going to take profits quick and trail my stop, that kind of thing. It's a little bit riskier. I know it's kind of an overnight. It's the opposite of what some people like to do. But I will say it's kind of a relatively, small position, looking for just a quick pop. So let's look at some other charts that sort of give us the environment. And, none of this is going to be profound. I will say that bonds, I look at TLT, is breaking out. You can hear about how low the yields are on the 10-year, and but what I will say with TLT is that we are coming into a little bit of previous resistance. So this isn't quite the same. I don't put it in the same category as resistance with stocks because bonds tend to be a more macro factor as opposed to stocks and the value of a company and what the shares should be. The bonds are more of a safe haven. So I'm not going to put a lot of credence in trying to short this level. I wouldn't do that. But I will say if we hit here, it is likely bonds could chop around a little bit, and that could be where stocks start to bounce. So right now, stocks and bonds are inverse. So there's a lot of fear in the market. Money's flowing into bonds because of fear of global growth slowdown and all that stuff. So I just want to be kind of cognizant of where could bonds sort of slow down a little bit. And we're pretty close to that level. So we could see one more day of selling, which would make sense. And then maybe we bounce Wednesday, Thursday kind of thing. But I am kind of keeping an eye on that. The other thing we'll look at is some of the other indexes. The Nasdaq's down 1.5%, but very similar to the S&P, sort of retesting the August lows. This was sort of a major spike low, but it is kind of in that general area. Let's take a quick look at the previous leaders were the FANG stocks. We got Facebook, which has just been getting murdered the last few days. I mean, it had this huge spike, but in all, it's it's down, from 117 to 99. So what's that, 17% in a week, which is a huge pullback. However, it just hit a 52-week high, right? Blew it out of the water with earnings. It's not, okay, let's go back to, where's the August low? Right here, okay? Nowhere near that. Doesn't mean it can't retest 90. I'm not saying to buy Facebook. What I'm saying is this is an outperformer. If and when you want to catch the knife, I would prefer to catch a Facebook knife instead of an Amazon knife, right? Here's the FANG. Amazon, near the low, similar to the market, missed on earnings, right? So not interested, right? Netflix, another sort of issue type stock. I mean, it actually was up on the day today, but it's actually taken out the August lows. Okay, so these are underperforming. I don't want to touch those. If Netflix got down to 70, I would be interested, right? Longer term, deep in the money call options, sell the what out of some put spreads. I'm interested in Netflix. I'll call it 70, all right, high 60s, but here, not really, not interested right now. And the last one, Google, also had great earnings, very similar to Facebook. And you can see again, August low is here 600. It's trading at 700. Okay, so these are the two names that, if and when it's time to add some risk, I'm adding it here. The third one I'll bring your attention to is Verizon, and I want to talk about Verizon. I mentioned this a few weeks ago that I was looking to pick up position. I picked up, if you check the YouTube channel, I picked up Verizon in the mid 40s. And if you look at Verizon, you just forget everything we just saw. This stock is hitting 52-week highs, right? I mean, just think of what the market's done the last, couple days. Verizon just doesn't care. So why is that? Part of the reason Verizon is up so much is because it has a huge 5% dividend. Obviously it makes a lot of its money off cell phone communication. I don't know anybody where the economy is so bad that they can't have a cell phone. So with the dividend and the fact that it's a steady business, this isn't a growth stock. I mean, it's not like, it's barely hitting where it was last year, but it's a steady sort of income trade you can put money into. I would just pick some up. I don't know if I like it here at 50 because I got in at 40, I think it was 44, 45. So I'm just hanging on for the dividend. However, if we pull back, if the market gives up the ghost and Verizon gets back into the upper 40s, there's going to be a lot of support there at 47, 48. I would buy the out of Verizon. And this is a longer term play. This is more for the dividend, the 5% yield. Okay, so those are some names you can kind of keep an eye on for the long side. Let's take a look at some other ETFs on a macro perspective. We got the XLF, just continues to drip lower. A lot of this has to do with the dollar. There was a lot of hope, late last year. If you look at November, right, here's November. December came around and hopes got dashed. But basically, the general idea is that the higher rates go, banks can make more money. The lending picks up. in a strong economy. And I think we're getting a double whammy right now where rate hikes are going to be off the table. We're in a slow growth environment, and banks just aren't going to make the money that that was sort of the hope was in late last year. So banks are going lower, even though Goldman Sachs kind of blew it out of the water as far as their earnings go. I mean, the stock really didn't react. So a lot of times, if you guys have been with me a while, I like stocks that do well on earnings and look for pullbacks, but really I'm looking for the reaction. So even though Goldman Sachs had a strong numbers, the stock people aren't into the stock, so we wait, right? And a lot of the banks are obviously at the will of the Fed when it comes to rates. If rates aren't going to go higher, banks are going to be sort of lackluster, right? So I am not wanting to be long banks right now. Let's take a look at some currencies. So again, we'll look at the US dollar. I like to look at UUP. And what do you know? This looks exactly like the XLF, right? Not exactly, pretty close. So the dollar is headed lower. And we'll see what the Fed says. This is going to be a Fed trade. If the Fed says, hey, the rate hikes are off the table for March, which is very possible, the dollar could actually go lower. And what this is doing is giving all the gold bulls a chance to tell you, I told you so. Man, there's nothing more annoying than a gold bull. And the reason I say that, I'm sorry if I offended you. The reason I say that is because typically the guys that I've been listening to have been saying that when GLD was back at 150. Gold is in a downtrend. Doesn't mean it's not breaking the downtrend right now. However, for the next, in a year or so, you would think rates probably would go up, right? And when rates go up, the dollar goes up and gold gets murdered. So with that said, I am not opposed to buying pullbacks in gold for short-term trades, but I am not a long-term gold investor believer guy, right? And I know I have some friends that let's look at silver. They're way into silver, and they don't want to listen to me. Silver is in a downtrend. Hello, this isn't rocket science here. It's going from the top left to the bottom right. Yeah, we're getting a pop. Could this be the turnaround? No. Could this be the turnaround? No. Could this be the turnaround? No. Could this be the turnaround? Maybe, but 1, 2, 3, 4, probably not, right? Now, could we retest some of these levels and start putting in a range? Absolutely. But I just want to point out that more on the macro level that a lot of the metals move have to do with the Fed and whether or not they're going to raise rates. Right now, they're not. Dollar's going lower. Metals are going higher. Play it how you want. So the next thing I want to look at is a monthly sort of income trade that I do, and I've adjusted it for this environment because the volatility has picked up so much. So I'm looking more for this trade to yield about 10, maybe 15% per month with a super wide Condor spread on the SPX. So let's dive into that now. So we're going to take a look at the SPX and try one more time. There we go. And let's go back to a daily chart. And I have one of these spreads on now. In this account, I just have, let's go to the trade tab, I'm sorry, analyze tab. And I have two spreads right now. And basically I have a Condor spread that's up about 10%. I have more of these in a different account, but I wanted to show you a single spread that you can look at, and then you can scale it how you want. You can do 10 of these, you can do 20 of these. The SPX options are pretty liquid. I like to do, no more than 10 to 20 per order, and I like to leg into this, and we'll talk about that here in a second. So in general, I'm going to take off my current trade, right? And let me move this up a little bit so we can see this. So I have one priced out. I'm looking at April options. They're all call options. I'm looking to buy and sell a call option at the bottom and then sell and buy a call option at the top. So this is a debit spread, the 1740, 1750. And the reason I picked these strikes is because right now SPX is trading at about 1850. Okay. So what I did was basically go up 100 SPX points to where I'm selling about the 1950, and then I'm going to go down from the current price about 100 SPX points, and I'm going to sell the 1750, and I'm going to buy a call around that to protect myself, so I'm not selling naked options. Okay, so when I put this on the chart, you can see that I have this huge range here. And this light blue line is basically the risk profile for a condor spread. If you trade iron condors, it looks like the exact same thing. Iron condors are slightly different, where you'd be selling a put spread and selling a call spread. In this case, I'm buying a call spread and selling a call spread, so it's a condor, not an iron condor. A little bit different. If you're interested in pricing out that yourself, go ahead. I get a lot of grief from the iron condor guys about this trade, but it works for me. So that's what I'm doing. So the other thing you'll notice is this is a debit spread. An iron condor would be a credit. This is a debit spread. The most I can lose on this trade, if I were to enter the trade today at this price, would be $4.25, $425 per spread. Okay. The max risk, you can see if this SPX is trading below 1737 at the time of expiration, which we aren't going to hold till expiration, and I'll explain that in a minute, I'll lose $425. However, if I'm in between these strikes, here's my break even, right? 1745, and my break even at the upside is 1955. But if I'm between 1750 and 1950, about 200 SPX points, this thing could actually turn into $575. So the risk reward here is more than 1-to-1 if you were to hold it entirely until expiration. I don't typically do that. What I do with this trade, first of all, let's go to the option chain. Now note the April options have 66 days left. Normally I would put this on at 50 days left and do a 120 point spread. But since the volatility is greater, I'm going farther out, and I'm looking to get in this trade somewhere in the 60 days until expiration. So that puts us at April. Doesn't actually matter. There's no specific day. I would like to get into this sometime this week. But when I do get into it, I'm going to readjust it so that, right now we're trading at 1850. Let's say at the end of the week, the market sells off and we're at 1830. I would simply adjust the spread to where 1830 would be the middle, and I would sell the 1730 and sell the 1930. So I can adjust it according to when I enter. Right now we're trading about 1850, so that's good enough. Okay, so the typical trade for this is in about 3 weeks. This trade should make about 10% as long as we're trading somewhere between these levels. Now, you can see right now that this purple line is sort of it's the delta line. It's where it's sort of the profit right now line. So if I got in right now, I would be at break even. If we were to rally back up to, let's call it 1900, maybe 1920, right? I would actually start losing money in the trade. So what I do is if on a rally, I go in with a smaller position. So let's just say you go in with one contract, right? One spread, excuse me. And you were to rally, you could sort of leg into this with the idea that as soon as you get back in, or as soon as it pulls back, you would actually be in profit zone right there, and you can make your 10% actually a little bit sooner. However, if we sell off, I'm up slightly, but really this is since we're making money off a condor, time needs to pass. So there's no directional trade. This is kind of I hate to use the word crock pot, the set it and forget it, because you don't ever want to set and forget anything. However, there really isn't a lot to do with this trade. It is so wide that if the S&P were to drop, 50 points, let's call it, back to 1800, you'd actually be up in the trade, like instantly, right? 32 bucks on a foreign, you're already up 5%. If it were to rally 50 points, you'd be down, but like I said, I would be legging into it on the upside. If it just kind of chops around here, I just stay in my small position. And again, I'm looking to make 10 to 15% in about 3 weeks, and then I'm out of the trade, and then I'm looking for the next round. And like I said, because volatility has picked up, I want a wider spread, and the only way to do that for the same risk reward is to go out to about 60 60 something days, right? So so that's the trade. I'm really kind of waiting to see. I want to put the break evens on the chart. So my break even here is set, I'm going to call it 1745. My break even on the upside is 1955. So we go back to the chart. This isn't the break evens for the one I have that expire. So I'm up 11% in this trade, and I'm probably going to let this go a couple more days and close out my March one and look to get into the April one. So I'm rolling this out sort of. So, but with this trade, I'm gonna edit this chart. And remember, we said 1955 on the upside, and we said 1745 on the downside. Okay, so let's do this in here and do this. Okay, so we're trading right, relatively right in between there. Let's double check that. Yeah, 1955. Okay, so basically, if in the next 3 weeks, if the SPX stays somewhere between this area, right? I mean, think about that. Think how far that is. It doesn't look like a lot, but for the SPX to go down to 1800 and down to 1750, chances are we're going to bounce back into this area. And if that happens over 1 week, 1 week, 1 week, 1 week, 4 weeks in, you got 15% gain. Okay. So that's my trade I'm looking to get into this week. I'm also looking at those short-term buys in Facebook, Google, Verizon, and that's what I got. Don't forget to get a copy of my trading plan at the website, and we'll see you at the next update.